Let's go over a tax return together. Maybe you do your own taxes and you just want to make sure that you're doing it right, or maybe you have someone else do it for you and you want to know how to read the thing and how to be able to tell if it is being done right, because ultimately it's you that is responsible for your own taxes, even if you have someone else doing it for you. So I think everyone deserves an opportunity to understand their taxes as much as they would like to. So in this video, I'm going to walk you through the main tax return and the line items that you're going to see whenever you file your tax return. Let's jump in. This is your 2025 individual tax return. So this is for US based taxes, assuming that you're subject to US taxes. I'm not going to talk about foreign stuff in this video. And even if your business is an S Corp or a partnership where it's filing its own tax return, all that income is going to eventually flow through to this tax return. And if your business is an LLC or a sole proprietorship and it's filing a Schedule C, then it's going to be on this tax return as well. So I'll show you where those show up. I'm not going to dig super deep into any one item. I just want to walk you through what you're going to see whenever you look at your tax return. If there's any part of this that you're like, wait, I want more information on that, let me know in the comments and I will do another video on just those. So at the top of your 1040, you're going to have your name, first and last, social security number, same thing for your spouse, home address and all that. What you should be doing in this section is just double checking things. Double check the spelling, double check the address, check the number on the address, check your social security numbers, things like that. We could talk about filing statuses in a different video. It does kind of get somewhat complicated, but if you are single, you're not married, you would just do single. If you are single and you have a dependent in the house, and this starts getting complicated, you may be able to do head of household. If you were married at the last day of the year, you would do married filing jointly or married filing separately. Again, it gets kind of complicated. If y'all care about filing statuses, let me know and I can do a whole video on just that. This is a yes or no question. If you had any kind of cryptocurrency, Bitcoin, Ethereum, any of that kind of stuff at any point during the year, then you have to check yes. Dependent information here. Just check all the fields in here and see if everything looks good. Names, social security number, relationship. Just check all the stuff that you see in this field. Double check it against what you know. All right. At the bottom here, we start getting to the numbers. So a few years ago, they expanded this tax return to add all these lines just for W-2 income. And now they also have all these schedules. So I'm going to go through the schedules. I'm going to go through each of the lines. I'm going to skip over the stuff that probably wouldn't apply to most people. Most people, if you have a W-2 from a day job, then you're going to have this 1A filled out with box 1 from that W-2. It's just your taxable wages. Most people aren't going to have household employee wages, tip income not reported on line 1A. So that would be like if you didn't include your tips on your W-2, if you're a waitress or something, but normally those are included in your W-2. You're typically not going to have taxable dependent care benefits. These are all things that are pretty niche. Normally, you're going to have something in 1A for whatever your W-2 wages were. And then line Z is just adding together 1A through 1H. If you have W-2 income, you'll have that number here in 1A, and then it'll repeat here on 1Z. Next is interest and dividends. So if you have, let's say, a savings account, or if you have an investment account or anything like that, or if you have a CD that matured and you earned interest, then you'll get a 1099 for that interest, and that's going to go on line 2B. If any of it was tax exempt, like if it was municipal interest or US treasuries or things like that, then it would go in tax exempt interest on 2A right here. Qualified and ordinary dividends. I'm not going to get super deep into this, but if you own stock and that stock pays dividends, those dividends might be taxed at a different rate if they're considered qualified dividends. But on the 1099 that you get from the investment company, it's going to show ordinary dividends and qualified dividends. So you should be able to reconcile that pretty easily. Next, lines 4 and 5, these are for retirement accounts. If you have any kind of IRA distributions or pension distributions, you would see those here if they're taxable. You can have a 1099 or that will show you your retirement distributions, even if those were rollovers or those were non-taxable for whatever reason. So you'll see the total amount of the distribution here on either 4A or 5A, and the taxable amount here on 4B or 5B. And again, that 1099 or is going to have two numbers on it, total distribution and taxable distribution. Social Security, if you were receiving Social Security benefits, you'll see the total amount of Social Security listed here on 6A. and you'll see the taxable amount listed here on 6B. The taxable amount is going to be determined by your other income. Up to 85% of your Social Security benefits may be taxable depending on how much other income other than Social Security you have. Capital gains and losses, this is on Schedule D. I'm not going to show that, but if you had like stock transactions, if you sold stocks, that's going to go over on Schedule D, and you'll put the gains from that here. Capital gains and losses get pretty complicated. If you have any capital losses, that's like losses from stock transactions, you can offset those losses against capital gains, but you can only show a net loss of up to $3,000 per year, and the rest of it gets carried forward. Again, not going to go super deep into that on this video, just want to show you where that would show up. All right, and then this line 8, additional income on Schedule 1. And you would think like, okay, that might just be a couple of things. This is literally everything else, and it's a lot of different things. So I'm going to go over to Schedule 1 now and walk through it. Just keep in your mind right now, though, that up to this point, we have covered W-2 income, interest income, dividend income, pension and retirement income, and Social Security income. Pretty much all the things that you would expect to see like a tax form for. Now, over on Schedule 1, this didn't used to exist. There used to not be a Schedule 1, and now, and some of these items were just on 1040. Now we have this long schedule with all the other stuff you might see. And Schedule 1 shows both income and adjustments, which are decreases or deductions from income. So I'm going to focus first on the income side. If you just look down the list, you can see all the different things that may be added to your income. Taxable refunds. So if you had a state income tax refund, it may be taxable on your federal tax return, depending on how you filed last year. If you received alimony, depending on when it was received, the date of the divorce, the date of the separation, and everything else, that could possibly be taxable. So that would go here. Business income from Schedule C. This is the big one. I want to show you this one. This is where if your business is not an S-Corp and it's not a partnership, and it's just like either an LLC taxed as a sole proprietor or not even an LLC, then that net business income is going to go here on line 3, and you actually have to have another schedule that this comes from. This comes from Schedule C. So I'm going to jump over to that now, and you can see why this gets complicated, because you have like things on this form that come from this schedule, but that number comes from this schedule, and it just keeps going all the way. So over on Schedule C, this is the profit and loss from business. And here's the things you want to look out for on this one. Make sure that it's the correct person. I have seen it happen before where, let's say the business is actually in the name of one spouse, but whenever you prepare your tax return or whenever the tax preparer did it, they didn't indicate that in their software which spouse it belongs to, and it's actually being put on the other spouse. And you might think that's not a big deal because you're filing jointly, but it is a big deal because this is how you get Social Security credit. If you're putting it on the wrong spouse, then the spouse that it should have gone on isn't getting that Social Security credit for whenever they retire. So it's important to make sure that the correct name is up here for who is the owner of the business. Is it spouse number 1, spouse number 2, whatever. And that is their Social Security number in this box here. If your business has a name, that would go here on line C, business name. If you don't have a separate name, if you're just like a sole proprietor, then you just leave that part blank. Principal business or profession, this would be kind of like, what kind of product or service are you selling? Are you an author business, or are you an artist, or are you an editor? Whatever it is, you would put it there, and there's going to be an NAICS code that you would look up for line B. If your business has an EIN, you're going to want to put that in line D. If your address is different from your home address, that would go here. An accounting method. Most people are going to be cash basis taxpayers, so most likely be that. Did you materially participate? It's usually going to be yes. If it's a brand new business, then you would check this box for saying that it started during the year. If you made payments that require you to file a Form 1099, you have to say yes. And then it asks you, if yes, did you file those 1099s? So they basically do it as a two-step question, because they're saying, well, if you were required to, they're not going to assume that you did file them. They want you to like affirmatively say yes or no, I did or did not file those 1099s. All right, so on the income part, this is pretty straightforward. How much did you receive from your business? That would go on line 1. That would be the top line revenue. Now, things to watch out for here. Did you collect sales tax from your customers? And if you did, are you including that sales tax received in income? If you are, then you should back that out, because that's not really your income and it's not your expense. Did you have payment processing fees deducted from your payments from like PayPal or Shopify or whatever? If those payment processing fees were deducted, your 1099 from those processors is probably going to be the total amount before those deductions. So you want to make sure if you're putting the 1099 amount in here as income, then we want to make sure that you're deducting those payment processing fees down here if you had any. So just check against what was actually deposited into your bank account for business income against the 1099s that you received. If you had any returns or allowances, like if you had to return income to customers just to make it match up with your 1099 stuff, you would put that here. Cost of goods sold, this would be like the inventory purchases and things like that would go here. I'm not going to go super deep into inventory on this video. And the net of all those things would be your gross profit. If you had other income, you would put it here. Usually not going to have other income on a Schedule C. So then your gross income is your total receipts minus returns minus your cost of what you sold, right? So that's your gross income. Down here on the bottom, it's all the expenses. Now, I'm not going to go through each one of these. I actually have a separate video. I'll try and remember to put the little cord at the top of the video here so you can click over to that. But I have another video that we go through all the different deductions here and what you would put in each one. You add all those together, you have total expenses. You subtract your gross profit. You subtract your total expenses from your gross profit and you get what's called tentative profit on line 29. From there, you deduct your home office deduction if you were allowed to have a home office deduction. You can't take a home office deduction if you already are showing a loss, and your home office deduction can't create a loss. So if line 29 here is a negative number, you're not going to have a home office deduction. If line 29 here is, say, I don't know, $500, and your home office deduction would have been $1,500, it's limited to the 500, so that line 31 is 0. You can show a loss on a business, but your home office cannot create or increase a loss. I think I'm going to do a whole separate video on home offices. There's different ways to do it. There's a good way and there's not so good of a way, and there's things to watch out for with home offices. So that's a whole other thing. Comment if that would be useful for you. I can do a home office video if you'd like it. All right. Typically, you're not going to worry about this at risk or not at risk if you're an author. Here's a calculation of cost of goods sold on the second page of Schedule C. Usually your cost of goods sold is going to be whatever you paid for your inventory. There's some situations where you might actually have to add up all the costs of your inventory and report that and only report the amount that you sold. We can go over that in another video if you think that would be helpful. You're going to have your vehicle deduction here, mileage. We talked a lot about mileage and vehicle deductions and travel deductions. The information for that goes here. And then any other expenses that aren't listed here at the top would go into that other expense item at the bottom. They would be totaled up there and come up here as other expenses on 27B. So just know this is all the income and expenses of your business. And this bottom line, line 31 from Schedule C comes over here onto Schedule 1 on line 3. So that would go here. Other gains and losses, you typically won't have this. This would be like if you sold property, business property, you might have a 4797 or a 4684. It's an author business just doing the regular year-to-year thing. You normally won't see that. Now, I wanted to talk a little bit about number 5 here. Line 5 is for Schedule E, and I'm not going to talk a lot about it, but I will show you Schedule E. Schedule E is where you're going to see two different things. One, if you had true rental stuff, like you had a rental property, is the income and expenses are going to show here on Schedule E. If you had true royalties, now, I've talked about this before. Whenever you're a self-published author, or a self-employed author, even if you received royalty income from Amazon and you got a 1099 that says royalty income, that royalty income should not be on here even though this says royalties. The IRS is very clear that if you are a self-employed writer, then any royalties received should be included over on Schedule C where you're reporting your business income, not on Schedule E as royalty income. And that's probably one of the biggest mistakes I see authors making is you enter that 1099 that shows royalties into your tax return, into the tax software, and the tax software treats it as royalties because it says royalties, and that's actually not the way that that's supposed to be handled if you are a self-employed author. So just know that. But any actual rent or other royalties like oil royalties, or if, I don't know, you were like an extra in a movie and you got royalties for that, but you're not employed as an actor, then that will go here as well. And any expenses associated with those. The second page of this is where you're going to list income if your business filed its own tax return. So if your business filed its own tax return, S Corp or a partnership, if it's an S Corp, it'll have filed 1120S. If it's a partnership, it'll have filed 1065. That tax return is going to report the income and expenses of the business. But then that business and that tax return is going to give you what's called a K1. You're going to put the net income from that K1 on this page here. Now, this gets a little bit complicated with passive income and non-passive income and what's allowed and not allowed, and Section 179 expense and all these other things. And this is why S Corp tax returns get so complicated, because there's so much more information that has to be reported. But just know what you should see if your business files its own tax return is the name of the business here, whether or not it's a partnership or an S Corp, the EIN, that employer identification number, and somewhere in this second section here, you'll see the income from that business. And that income is going to all get added together with all your other rental income, and that's going to end up showing up here on line 5. So line 3, business income. Line 5 would be either rental income or partnership or S Corp income. I'm not going to go through the rest of the schedule. You can see here, it's just a lot of other things: net operating losses, gambling income, cancellation of debt income, jury duty pay, stock options, basically anything else that could possibly even have an other income if something somehow isn't listed here. So all that gets added together to line 10, and that goes all the way back here to this 1040 that we were talking about way at the beginning of this video, down here on line 8. So we're going to add together all these income items: W-2, interest, dividends, retirement, Social Security, stock transactions, and everything else from Schedule 1 to get to total income, right? So that's your total income on line 9 from all sources. Next, we're going to get to adjustments to income back on Schedule 1. These are what used to be called above the line deductions. It's because it's above this adjusted gross income line. You're going to deduct these before getting to adjusted gross income. And the reason that matters is because some tax credits and some deductions are actually based on your adjusted gross income. That adjustment to income, those deductions are going to come from, again, Schedule 1, but the second page. I'm going to go through just a few of these. This is where you're going to see like educator expenses. If you're a teacher, you can usually deduct up to $300 of your costs that you paid out of pocket. Health savings account deductions if you contributed to an HSA outside of payroll. If you contribute to an SEP, so this is a great option for self-employed people. I can do a whole video on retirement options if you want us to. Self-employed health insurance deduction. If you paid for health insurance out of pocket, you can get a deduction if you're self-employed for that. Let's see what else might apply to you. Really not a whole lot of anything else on here. Yeah, so that's what you're going to see as adjustments to income. Those adjustments to income get subtracted from your total income to get to adjusted gross income. And then we move on to the second page. This just repeats right here. 11A gets dropped down right here. And then you have some information about, can you be claimed as a dependent on someone else's tax return, or you're a spouse as a dependent? Does your spouse itemize on a separate return? All those things. Are you blind? Were you born before a certain date? And that all matters because you get extra tax deductions if you were. This next line item is your standard deduction or itemized deduction. And this is a big deduction. If you are single, you get about a $15,000 deduction. If you're married, you get about a $30,000 or $31,000 deduction here. And that's $15,000 or $30,000 that you're not going to pay taxes on. The IRS just gives it as a freebie. You don't have to do anything for it. Now, if you want to, you can itemize your deductions. The reason you would want to itemize deductions is if you have more deductions available than what you would get for free taking the standard deduction. And so to figure out if you have those deductions, you fill out Schedule A. Schedule A lists the deductions that you could take. I'm going to go through these pretty quickly. You can take medical deductions, but only to the extent that they exceed 7.5% of your income. So if you made $100,000, you'd have to have $7,500 of medical expenses, and then only what's above that $7,500 gets to be used towards these itemized deductions. If you paid state and local taxes, real estate taxes, sales tax, income tax, there are certain ways to deduct those here. You can deduct up to $40,000 of those here. It used to be $10,000. Now it's $40,000. There are some thresholds there if you have income over $500,000, but I'll just say usually you can deduct up to $40,000 here. Mortgage interest that you paid on your primary residence can be deducted, and gifts to charity can be deducted. So usually the deductions we see here are mortgage interest, taxes, state taxes, and gifts to charity. If those things or exceed your standard deduction, around $31,000 if you're married, around $16,000 if you're single, then you would take the bigger deduction instead of that standard deduction. So that comes off right here, 12E, and then you have one more deduction before getting to taxable income, and that is called your qualified business income deduction, and you fill out Form 8995. This is a deduction that you get for having a business, whether it's an S Corp, partnership, or a Schedule C. You typically get to deduct about 20% of that net taxable business income from your tax return, and you're not going to pay income taxes on that 20%. There are some exceptions to this. There are certain types of businesses that can't deduct that. There are some limitations here, but just know that you should see a little bit of a deduction here. After all that, usually you're not going to have any, this is actually new. Schedule 1A, this is where we're going to see these new deductions from the One Big Beautiful Bill Act that passed in 2025. And this is going to be things like your overtime deduction if you had overtime, your tips tax deduction if you had tips, your vehicle interest deduction is going to all be somewhere in here as well. So if you want more videos on those changes, let me do another video just on that because that's handled differently. After all that, we get to taxable income. So just to recap before we go any further. We had all your personal income, W-2, 1099, dividends, retirement, Social Security. We had business income, rental income, royalty income, S Corp income, partnership income, all that gets added together. Then we subtract out your adjustments to income. That would be like your self-employed health insurance, your retirement contributions that might be tax deductible, your SEP, things like that. Then we subtract out your either standard deduction or itemized deductions. And the itemized deductions would be your mortgage interest, your real estate taxes, your charitable contributions. Then we subtract your qualified business income deduction if you qualify for that. And then we subtract those new deductions like your overtime pay, tip income, those types of things. And then finally get to taxable income. From taxable income, we're going to calculate your taxes. Now, your taxes are calculated on what's called a progressive tax system. That means if you're in the 22% bracket, you're not paying taxes at 22% of all your income. Instead, you're going to pay the first amount of taxable income is going to be at the lowest rate, 10%. And then the next amount is going to be taxed at 12%. And then above that's going to be taxed at 20% and then, or 22%. And above that's going to be 24% and so on. So it's only that next dollar of income that is taxed at that rate that you're in. And then once you move into the next tax bracket, anything above that is taxed at that new tax bracket. So just keep that in mind. If you were to take this line 16 divided by line 15, the percentage that you get is not going to be your tax rate unless if you're in that 10% tax bracket where everything's being taxed at 10%. From there, we have Schedule 2. Schedule 2, did I bring it up? Yeah, sure did. These are additional taxes you might pay. And the only reason I bring this up is for two things. One is this advanced premium tax credit. If you had taxes from the marketplace, health insurance from the marketplace, then whenever you signed up for that marketplace insurance, you had a subsidy possibly. That subsidy reduced the amount of premiums that you pay, and that subsidy was based on your income because that subsidy is actually a tax credit. It's an advanced tax credit that you're getting throughout the year to offset your insurance premiums, the amount you pay every month. If whenever you file your tax return and you get that 1095A that reports how much you had for health insurance, if you qualify for an actually lower income tax credit based on your income, because maybe your income was higher than you thought it would be, then you have to pay back that premium tax credit. You have to pay back that subsidy to the amount that you should have gotten. So for example, if you got a reduction in health insurance benefits that totaled $5,000, but you only qualify for a $3,000 tax credit, you have to pay back that $2,000. There's some other taxes on here that you might have to pay. The only other one I want to talk about here, though, was the self-employment tax. So self-employment tax is the way that the government makes you pay Social Security and Medicare on your business income. So if you were employed through a W-2 job, you had 7.65% withheld from your paycheck and being paid to the government for Social Security and Medicare. And at the same time, your employer would go into their own pocket and match that same 7.65% and pay it on your behalf for Social Security and Medicare. So you would have a total of 15.2% being paid on your behalf for Social Security and Medicare. But because you don't have that withholding and because you don't have an employer for your self-employed income, you have to pay that both employer and employee portion of self-employment tax whenever you file your tax return if you were like not an S Corp. So that additional tax would go here on line 4. There are ways to get around self-employment tax, like doing an S Corp, but there's additional costs. There is another video that I did on how to do on when it makes sense to do an S Corp. So I'm going to try to link to that as well. So those taxes and any other taxes other than income taxes that you might have would all be listed here. These are all the other taxes that you might end up having, and they would go on line 21, and then those would go here. So you'd have your income tax plus other taxes like self-employment tax or your advanced premium tax credit payback, and then tax credits. So these get complicated where they show up. You have 2 places that tax credits show. You can either have them here or you can have them down here. The difference is you have refundable credits and non-refundable credits. A non-refundable credit is limited to the amount of taxes that you owe. So if you owed $5,000 in taxes, and this is before considering anything that you withheld from your paychecks, and you had $7,000 of non-refundable tax credits, you'd only be able to use $5,000 of those non-refundable tax credits to get your taxes down to 0 before considering how much you've withheld from paychecks. Part of the child tax credit is non-refundable. Your Schedule 3 credits are non-refundable. Those are over here. Some of your non-refundable credits are on Schedule 3. Those would be like your foreign tax credit, dependent care expenses, retirement saving contribution credit, all these other tax credits. Going back to 1040. Then you have your total taxes due after other taxes and after non-refundable tax credits. From there, we're going to subtract the amount that you've already paid in. You might have had withholding from a W-2. You might have had withholding from a 1099, like if you had a retirement distribution and they withheld taxes for you. You might have other withholding from other places. All that would be added here. And then maybe you made estimated payments during the year, quarterly payments. Maybe you had an overpayment from a previous year that you applied to this year. That would go here. And then any other refundable tax credits would come back down here. That would be like education credits, refundable adoption credits, and then over on Schedule 3, you do have some refundable credits down here. Like if the opposite happened on your health insurance where you actually didn't get enough of a subsidy, you get that tax credit here. And so then we end up with the total amount of payments and refundable credits to say, did you have an overpayment? Like, did you pay in more than you needed, or did you have a balance due? So just to recap this part, we started off here with adjusted gross income. Then we took our standard deduction or itemized deduction. Then we took our additional deductions, and we finally got to taxable income. From taxable income, we calculated our income tax. We added in other taxes like self-employment tax. We subtracted our non-refundable tax credits, and we got down to total tax. Then from total tax, we subtracted the amounts that you already paid in throughout the year through withholding or through your quarterly payments. And then we subtracted your refundable credits, those tax credits that can create a refund. And then we ended up with either an overpayment that you can have refunded to you or applied to the next year, or the amount that you owe, which you send in a check, or you don't send in a check anymore. The IRS stopped accepting checks. You pay that online, or you let them draft it from your bank account. Wow. So I think that was one of the longest videos I've ever done. I apologize. I don't know why I thought that wouldn't take so long. I'm not even sure if I'm going to post this video or take the time to edit it. If you're seeing this, then it's because I couldn't think of anything else to record or I ran out of time. So if you made it all the way through, congratulations. Now you can kind of see what all goes into a tax return, and maybe at the very least you have an idea of what to expect whenever you're looking at your taxes. If you didn't make it all the way through this video, I would not blame you one bit. So if there's anything in here that you saw that's like, man, I really wish you'd spent more time talking about this tax deduction or that tax credit or the way that this is done, let me know in the comments and I'll do a separate video on that. In hindsight, maybe I just should have broken this into a few different videos, but we're here. So hopefully this was helpful and not too excruciating. I'll see you next time.